Yeah, friends, now we will discuss internal rate of return based on Excel sheet which is displayed before you. In the Excel sheet, we have considered various assumptions has been made. The capacity of 1 megawatt, cost of per megawatt has been considered 7.5 crore. Capacity utilization factor, which we already discussed, has been considered 19.5%. Because case seems to be based on Rajasthan. Duration factor for first year, because most of the module manufacturers specify a higher derating factor for the first year. Year on year duration factor from second year onwards has been considered 0.7%. Thus, generation for first year is 16.74 lakh units per megawatt. Length of transmission line has been considered at 5 kilometers and a total loss of 0.25%. This is a fixed tariff of 7.5% for 25 years has been considered. So, there is no escalation provided in this case. Grid emission factor of 0.916 has been considered. CER rates of 1.5 euro for one carbon credit has been considered in this case. A revenue sharing of 50% with distribution company has been taken into account, and CDM benefit carbon credit benefit accrued from second year onwards. Number of years of CDM benefit will be 10 years because there are two cycles which we have considered for 10 years. VCU rates has been considered for $2 a VCU. Now we come to project financing. Debt has been considered approximately 70% of the total cost of project. So equity is 2.25 crores per megawatt, and interest on long term loan has been considered 12.5%, and the period of loan is 10 years and a moratorium period of 1 year, during which we need not pay any principal amount, only the interest has to be paid. Now coming back to the operational expenses, we have considered O&M charges of 6 lakhs rupee per megawatt and an escalation of 5%, an insurance cost of 0.5% of cost of project. Then O&M charge, this working capital requirement has been based on O&M charges as well as spare stocks or accounts receivable of 1.5 months. And we have considered interest on working capital as 12%. This is a minimum alternate tax has been considered 20%. Income tax, normal income tax 32%. Now we, as discussed earlier, we have to start 80IA holiday from 4th year onwards, because there will be depreciation available for till 4th year, and there will be negative profits. So from 4th year to 14 year, we take the benefit of 80IA under Income Tax Act. In this case, we have considered book depreciation 15.33%. Here we are taking accelerated depreciation. In this case, we consider accelerated depreciation because this is an existing company who is going for installation of solar project. So, and we have considered commissioning date in March. So, accelerated depreciation we have considered 50%. So, once you fix all these parameters, we can see that the project IRR is coming 14% and equity IRR is coming 16%, and the debt service coverage ratio it's 1.28, which is little higher than what the banks normally expect. Now if you want to change from accelerated depreciation accelerated depreciation to non-accelerated depreciation basis. So now you see the parameters have changed drastically. Equity IRR has been changed to 12%, which is substantial, because of the accelerated depreciation benefit, the project is gaining a lot of funds. Now we talk about changing in commissioning date. If you want to commission before September, then what is the advantages? Even though the equity return has not changed much, might be a point%, but the DSCR has reduced drastically from 1.28 to 1.2%, 1.2, so which is a substantial change. So we can look into other template also, where we work out on the basis of REC mechanism.